Types of businesses is a really big topic. So looking at the types of questions we could expect, there'd be things like describe, explain, or outline the characteristics or the features of a type of business. Identify and describe, explain, outline what type of business this is. So you get a case study and you've got to spot what type it is and then explain those characteristics or features. And lastly, maybe discuss or evaluate the pros and cons, advantages, disadvantages, however you want to put it, of each type of business. So to do that, we just need to remember that the types of businesses in Australia are divided into the private sector, owned by the private individuals, groups and institutions, versus the public sector, which is owned by the government. And in the private sector, we've got sole traders, partnerships, companies, there's two types, and social enterprises. And in the public sector, we've got government business enterprises, and that's everything. They're all the ones we need to know. So for each one, we kind of want to look at the same features or characteristics. So for each one, we're going to look at the number of owners, and for sole traders, it's just one. Can't be any more. We'll look at the management and risk profile. So the owner has 100% responsibility to manage the business and 100% of the financial risk. So that's for a sole trader. We'll look at the profit distribution. So the owner gets 100% of the profits or dividends with a sole trader. Liability, it has unlimited liability, and perpetuity, it does not have perpetuity. Make sure you go and revise these terms. What does unlimited versus limited liability mean, and what's perpetuity? Looking at partnerships, or actually we'll look at the advantages and disadvantages of each, obviously, and that is, with a sole trader, easy to set up. We can jump online and set one up today. It's not hard. You've got total control over it, and therefore you get all the profits. It's pretty simple to wind it up and start another one if you need to. And compared to the other types of businesses, there's minimal government regulation. What about the bad things? Well, yeah, you got that unlimited liability. That's a huge disadvantage. It's also really harder to finance the operations because it's basically relying on the owner's money or to borrow. And then little management knowledge and resources. It's heavily reliant on one person who might not be good at, say, marketing. They might be good at finance, and therefore the marketing of the business suffers. Then we have partnerships, 2 to 20 owners, no more, called partners. Doesn't have to be equal. So it could be one person owns 60% and 4 other people own 10%, and therefore the profits or dividends are shared amongst those partners based on their percentage ownership. Has unlimited liability. Some do have limited liability. We'll just say overall most of them are unlimited liability, and also has no perpetuity. Strengths and weaknesses. Well, it's again pretty inexpensive and simple to set up compared to companies. You got a range of skills from all the different owners, and you share the risk. Pretty minimal government regulation compared to companies, and if you do work at the business, which you do not as a partner, the workload is shared. Disadvantage, you got that unlimited liability. Each partner is responsible for the debts incurred by other parties. You're at risk of one partner leaving. It doesn't have perpetuity, which makes it complicated, and when you involve people, there's potential for disputes and clashes. Companies, there's two types. There's a private company, Pty Ltd, and a public company, Ltd. So owners, 2 to 50 with the private company, and we call them shareholders. And these ones are not on the Australian Securities Exchange. You can't buy shares in private companies on the stock exchange. But a public company, you can. No maximum number of shareholders. So say BHP had, I think, over 1 million shareholders, 513 million shares, and the shares are on the ASX. Management and risk profile, you delegate it to a board of directors. Just because you own it doesn't mean you have to run it. And your financial risk is limited or shared to your percentage ownership. Therefore, you share in the profits based on that percentage ownership. They both have limited liability. They're separate legal entities, which is beautiful. And they both have perpetuity if an owner leaves. Advantages and disadvantages, well, we'll consider each separately. They've got some ones in common. Both got limited liability. Both have access to extra capital. All you've got to do is issue more shares. Both have perpetuity. And both can hire directors and managers to run the business. And for a public company, an advantage is you can easily buy and sell your shares online on the stock exchange. You don't need to find a private buyer. And you got an access to basically an unlimited amount of funds. You just need to put your shares on the stock exchange and find people to buy them. Disadvantages, there's some in common, very complex in a lot of lawyers and accountants. High degree of government regulation. So you got your government tax office and ASIC involved with these ones. You got to tell, your public information. With a private company, you're limited with funds. Remember, it's only 50 owners. But with a public company, I guess you don't have unlimited owners. Limited owners, you can have as many as you want, but you've got to publish all your financial information if it's what we call material. And you don't want everything in the public if you don't have to, and that's a real disadvantage. Private company, very hard for the owner to sell the shares. They can't be bought and sold on the stock exchange. Whereas over here, we would say a disadvantage for a public company is your little control. You might buy some shares in BHP and own 0.0001 of the business. You've got very little control. That brings us to social enterprise. That's owned by private individuals or groups. So it's not owned by the government. Don't think of it as a charity. That's not what it is. It's run for a profit by private people. Again, the management's directed or board of directors. The financial risk, it does have that. It's not a charity. Could go broke. Share between owners. The profits don't go back to the owners, or if they do, just a little bit. The profits basically go back to a social cause or to the local community. The liability, it is a separate legal entity, and it does have perpetuity. In terms of advantages and disadvantages, it doesn't really apply. I mean, it's not like you're choosing between this and another type. So we'll go straight to government business enterprises. A number of owners, well, it's owned by the government. It's owned by everyone, effectively. Everybody in Australia who pays tax effectively owns it, but we just say it's owned by the government at the 3 levels. Management risk profile, again, delegated to a board of directors. Australia Post is not run by the Prime Minister. It is run by a board of directors and a CEO, but the financial risk is with the government. Now, the profits go back into the business, so back into Australia Post, or maybe back to the government to invest in other things. Liability is not really applicable. The government's not really going to go broke, and it does have perpetuity. It is an ongoing entity that exists forever in the eyes of the law, and perpetuity. Does have ongoing